I think that you might be on the cusp of things getting really weird.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk.
And we are back with another edition of the Daily Dots, and I am joined as always by the brain trust himself, Mr. Chase Taylor. World peace is here again. Qs break out to new all-time highs. All of the ridiculous trash in the market is just ripping to the upside. And I'll be honest with you, from where I'm sitting, I feel like this has legs, and I think the earnings outlook for a lot of like the Meg 7 and the big caps doesn't look bad. I think the rest of the market's probably going to, I think several places, the rest of the market are going to have a really tough time. But the endless the buy stonks, man, the endless parade of ever higher stock prices is back. And here we go. That's what it looks like to me.
But even with that, whereas most countries are still beating the U.S. and the rest of the world even beat the U.S. today. So, but I think you're right. Like, we've had a lot of risk come into the market that's gotten pulled out, whether it was tariffs or a war, or there's been a lot of hills to climb, and we're kind of at the top of those now.
I just don't see it that way at all. I mean, I just don't see it that way at all. You've had virtually no movement on anything significant on the trade side of things, just none. But that's the way this, but that's also not new because, let's think of a geopolitical situation that has not been faded by this market over the last 10 years. I mean, there's not one of them.
Yeah. I mean, it will price it in a little bit along the way, but but this was just another scenario where the market was right. I mean, it would have been, at the end of the day, like, it was largely performative stuff. So, and it's over for now. So, but I think one of the points you made is maybe the most important one, and that is just, earnings. Those earnings expectations are still, it's a low bar. So
I don't see, and I've heard you say that multiple times. I don't understand what you're talking about. I look at Apple trading at 33 times earnings. I look at Microsoft at 38. I don't understand how that's not how the bar is low on earnings there.
But even with high PEs, you still have full year 2025 earnings expected to come in at about 7, and I think that's a low bar for where they can end up. Now that is
you mean for the broader market?
Yeah, I mean, as everything, we're basically talking about 10 to 50 stocks more than 500, but they're the ones that drive most of those earnings anyway. So, and I think that the size dynamic hasn't changed. Like that, there's been a lot of things that have changed or threatened to change this year. One of them is not size. Like you still have the situation where you can break out size by almost any like quadrant decile you want to across the whatever 3,000 stocks in our market. And it basically just all scores for size. And you can see it in, the Russell lagging and, mid caps lagging, like you name it.
Yeah. You're running. There's some interesting dynamics going on because if you get a breakout, with the Meg 7, like for instance, look at Nvidia and Microsoft alone. You put those together right there. Their market caps are worth 1/4 the size of the U.S. economy. Two companies. And look, I'm not trying to make a point or draw a conclusion because I don't know what that means. I mean, maybe, maybe I'm thinking of like maybe Ford in the 1920s or something like that. Maybe there's an example, or maybe there's a something similar that's occurred in the past. If it has, my feeling is it probably would have occurred at the time where the U.S. market and the U.S. economy was nowhere near as this developed. But what does that start meaning? I mean, if you get another rally here on Meg 7, they're going to be worth 50% of the overall market. 7 stocks making up 50% of the market cap of a 500 company index. I don't, and I just say that because it's just incredible to hear myself say it out loud. I don't know what that means. And then you got to kind of start asking yourself some more philosophical questions where, can you have companies be that big in relationship to market cap as a percentage of the underlying economy that they reside in, right? Can they be that big and not be a monopoly? I don't think so. I don't think that's possible.
No, of course not. I think we all know they're largely monopolies.
They're 100% monopolies. I mean, they're like we've been referring to them, and I think if you look at their earnings over the last 10 years and the mechanical nature in which they got, the point I've been arguing is that, and it's why we own some. The point I've been arguing is these are non-economic. I don't think these companies are exposed to normal economic winds. I think that they're like almost outside of the economy. It's kind of like they kind of remind me of like, when you walk around in New York, especially in the summer, it's really interesting because in the alleyways between the big skyscrapers, you can be like 20 degrees cooler than you are like out on the street. It's almost like they've gotten big enough to create their own ecosphere. You know what I mean?
Yeah,
like
no doubt.
They create their own climate.
Right. They're like Mount Rainier.
Yeah. There you go. And obviously nobody, including me, knows which direction the market goes. But just looking at this tape, looking at the stuff that's rallying, I think a part of what you saw today, and I don't know this to be true, but I think a part of what you saw today, and I was looking at some of the names going, this feels like some short covering on some of these names. People letting go of their last bastion of Iran conflict resolution type stuff. But I look at this more. I think that you might be on the cusp of things getting really weird because, I don't know. We'll see. I personally think the earnings estimates are overstated, and I think that you're at a really weird place here because, if you rally hard from here, you got to be looking at significant multiple expansion. Couple cuts by the end of the year isn't going to hurt that. But if you throw a couple cuts on this thing at the end of the year and this market keeps ripping to the upside, I don't know how inflation numbers don't climb right back up. That feels inflationary to me.
Yeah, I think the only thing keeping inflation from being like somewhat significant is just oil prices being low because, and we talked about this. I talked about this a little bit in our meeting today. Like I think the market has now soothed itself that inflation isn't coming. And I think the market thinks because we have had data come out since tariffs went on that the low prints mean the tariffs don't cause inflation, not realizing that the flow through that lag between, those tariffs being enacted and then them hitting the data that's still like a very alive lag that can still be, felt. But to Jay Powell's point on like, we don't know what this is going to do to inflation. Like none of us have ever sat through an experiment of like going from really low to really high tariffs all at once. And because some people make the good argument that it'll smash services inflation so hard that it won't matter that you have some goods inflation. And that might be right. My gut tells me, which, if that was true, that would be bad for some of these tech companies that are just hardcore on the services side. It's like some people would spend so much on actual goods, they would have to, pull back, or even some of these companies would have their margins squeezed so hard that it could become an issue. But I think the Fed's current end of year inflation projection of 3%, like that may end up happening. If that happens, like why are you why are we cutting? Like, so I don't think inflation is completely dead yet. I think obviously the housing side is dead for a while, and that's a huge deal. That's like 50% more or less of inflation. So that's a big deal. When you have no housing inflation and no energy inflation, like it's tough to have meaningful prints, but that doesn't mean goods can't sneak in there and make it a little painful for, the next year, starting, a month or two from now.
The thing I keep going back to is just what has been a very strange economic cycle in every way you want to look at it. I mean, you and I have talked a lot about how this has been the market cycle, economic cycle that has literally broken all past precedent. There's been so many age old axioms, right? Market rules that have just been shattered, right, left. And at least from my perspective, again, and we talked a little bit about this on in our investment meeting this morning. I think when you're looking for comps to this market, I really don't think there are any, not any good ones. I think that we're in an extraordinarily unique place right now where it's so weird. There's so many one-off dynamics that are all running at the same time. There's so many we've nevers, right, going at the same time. And I wish I could synthesize those into a firmer outlook or even a feel about where things are going, right? People are like, well, what do you mean? What about the economy? Look, I just don't think that the economy is that key to moving stocks anymore. And for that,
it's going down, like that's clear.
Yeah, people just don't.
These people can go up.
Yeah, well, and then of the Meg 7, speaking about those monopoly companies that we're talking about that are at the top of it, how much of their earnings, like what is a percentage of the S&P earnings do those companies put up?
A lot, yeah.
Yeah, so really, your bet on the S&P 500's earnings is just a bet on Meg 7 anyway.
Yeah, and
for the most part.
And it's tough too, because so I looked it up, and if you go back, like Standard Oil at one point was like 3% of GDP, and you're pushing 12 on those top two now, and you're pushing like 6.
How big did Standard Oil get? How big?
A little over 3%. And you had IBM get around there, but if you think about it, we didn't have globalization back then, so now you're not really tapping into U.S. GDP. You're tapping into global GDP if you're some of these names, and that makes it, a little more complicated. As we've talked about before, like the percent of overseas earnings, for tech is substantial. So,
yeah, I think that at some point, and I'm a free markets guy through and through, but at some point, I don't think that's an excuse. I think that's something to be afraid of. Meaning,
especially in a trade war.
Well, yeah. The other side of it is when you get companies that are that large as a percentage of your underlying economy, remember, their fiduciary duty is not to the red, white, and blue. It's to their shareholders. I almost wonder if you're getting to a point where these companies are getting to the size and the weight, and they're there. They're already there. But they can, they have the ability to have an extraordinarily outsized impact on the political environment, on the government writ large.
Yeah, that's all right. To me, that we're already there.
Yeah, I would agree. Yeah. To where they can almost like dictate policy.
I think if they all put their heads to it and decided they wanted a specific outcome, they could engineer it. No problem. I don't think they actually have much interest in doing that, because they just want to chase money. But I think if they all put their heads together and all right, here's what we need to do politically for America, they could manifest it. I have no doubt about that, especially with social media. If you engineer that correctly, you change everyone's view on everything. And there's a reason authoritarian governments have state media and they don't allow free media, right? Mm-hmm. So if you do the same thing, but via, what looks like organic conversations happening in the town square, it's powerful stuff.
Yeah. Yeah. I don't know, man. This is very odd situation for me. I do think it's interesting though that considering that rally, the rest of the world still outperformed them.
Speaking of, do you want to rip? You mean to rip through the rundown?
Give us a rundown on the indexes.
Yeah, S&P up 1.1, Q's up 1.5, and that's a new high. Small caps up 1.3, equal weight up about 0.9. Mag 7, thanks to some weakness in Apple and Tesla, Mag 7 was only up 0.7, and then all world ex-US was up 1.5. Dollar down about 0.4. Oil down another 5%. Gold down about 1.7. And then yields was a big story today. The front end was down about 4 basis points. The 10-year was down about 5. So yields have come down a good bit lately, and that's also really helping. I think that equities kind of get either make highs or get close to highs here.
Yeah, the rate action and the equity action isn't making a lot of sense to me.
I tend to agree on rates.
Yeah, and the reason I say rates most specifically, but the reason why I say that is when you're looking at a market that's trading at these kinds of valuations and these levels, and you see the back end starting to pull back, that's a recessionary signal. That's not a multiple expansion signal. Not at this part of the cycle. Yeah, that's a growth problem. But again,
I got more poor data today, like that's suggesting like growth is becoming incrementally a bit more of an issue as we go here.
Yeah, and I don't. And the other, to be fair though, we just got done saying those companies aren't economic. I still agree with that. I think that, and you brought up a good point, right? Just think about all the different economies they're plugged into, and think about the ability that gives them to shuffle a little bit over here, you know what I'm saying? Like they're almost at a point where they got to keep growing. I mean, they got to keep getting increased revenue, but they have so many ways to massage that number, to get it to be whatever they want to be, whatever they want it to be. They've got, cross currency actions going on. There's so many just different levers they can pull. And the other side of it is if you're looking for a big fall off on the S&P earnings numbers, for the index as a whole, unless those companies take earnings hits, you're just not going to see it. I mean, they just make up too big a difference. It kind of reminds me of remember it was back right around 15, 16 when we went through the shale blow up, and we had a quote unquote earnings recession, but just barely. I look back on that. And these companies weren't nearly as big then, but there was still a similar dynamic where you look back on it and you looked at some of the things that were going on at that time. I thought for sure we were heading into recession. And the earnings were negative on the index, but nowhere near as much as you would have thought, given all the places that were struggling. And that's when it hit me. I remember kind of having this moment of clarity during that whole deal, where I went, holy smokes, man, it almost doesn't matter what the rest of the market's doing. If Mag 7 keeps chugging along, they're going to pull you right out of any earnings recession you're in. It just doesn't matter.
Yeah, I mean, there were 52% of earnings growth last year.
Yeah, there you go.
7 of 50, and that's for more than half.
7 of 500, you mean?
So for earnings growth right now, just year over year, where they're growing. Now, earnings, not revenue. Apple growing at 8, Microsoft 13, Amazon 62, Alphabet 49, Meta 37, Nvidia 147. So they're all growing earnings at a very healthy clip outside of Apple. Now, revenue is way less impressive. It's 5, 13, 9, 12, 16, and 114. So,
yeah.
But, that tells you a lot about their profit margins are like twice the rest of what the rest of the market does. Like, but if you think about it, like I was just thinking about this in the context of a great Texas country song from Pat Green, "Wave on Wave." They've captured wave upon wave upon wave of monumental technological revolutions. They all monetize the internet. They all monetize mobile. Now they're all monetizing the move to the cloud, and they're going to monetize AI. So it's like, I think normally you think back to like all these behemoth companies that came and went. Usually they would get fat, dumb, and happy, and they would get disrupted. Like some new wave would happen, and they would be like looking at it from afar, going like, "Well, that they look like they're having fun over there. These guys, like all these companies for the most part, especially, the kind of the bigger ones we all think about, they've been there for all of those moves. Like none of them seem to be missing AI. None of them seem to be missing the cloud migration. Like none of them really missed in a meaningful way on mobile other than hardware. Like, and they all took a shot at hardware. Like Meta made a phone, Microsoft made a phone. There was just, it all turned into winner take all, and it will I'm sure with AI to a degree, but they're all going to make a bunch of money on it. And it's hard to think back in a time in history where you had more like profitable technological waves hit within a 30-year period. Like obviously, like we had that like turn of the century where, like you go like radio and TV and automobiles and airplanes and air conditioning. Like there was a lot going on, but it was the profit margins on that stuff versus this stuff like doesn't really compare. In the fight to make sure the profit margins came down when you had like 1,000 car companies in Detroit, like no one's going to get a margin.
Yeah. I don't know. I know that these are very odd times. It also begs the question, and I don't know. I don't really know if it makes any sense to even be long the S&P anymore. Like, why would you be long the S&P rather than just being long Mag 7?
It depends on when. I mean, there are times where, So like
there's short periods. There's short periods of time.
Industrials are killing the Mag 7 this year, and for a reason. Like, but that requires that tactical feel. Like you can't just be like a set and forget thing. Like if you sit in the average sector for a long time, you're just gonna light money on fire. Like biotech. If you've been in biotech for the last decade, like I'm sorry, But there's going to come a period where biotech destroys Mag 7 for 5 years or something. It's just about, who's able to actually recognize it and who's not.
Well, and ironically, and I was saying, and look, I don't profess to be some kind of systems or cloud or AI or whatever expert, not at all. But one of the things I was thinking about was as these large language models get better and better, and as AI gets better and better, and what we're already seeing is AI is already getting really good at writing code. I was talking to some people in the know that are involved in AI teams with Microsoft, another one with Amazon, and they were just telling me, they're like, I was like, so is it getting better? And they're like, over what time frame? They're like, it's getting better in 30-day clips. Like they're like, the one guy was explaining to me, it's sort of like Moore's law, but he goes, it's not every 14 months. He goes, it's like every 35 days.
Yeah,
right?
It's like Bill Gurley was just talking about that with like, if you miss the news for 1 week on this stuff, like you're like a dinosaur. You don't even understand what's going on anymore.
Yeah, you're behind. So one of the things I was thinking about was, I think one of the biggest drivers of this cycle and profitability for the Mag 7 has been software as a service, right? That whole change, right? Well, one of the ones that I was thinking about was a company like Salesforce. Okay. When these LLMs are getting this good at writing code, how far away are we from just plugging into an LLM and having them just custom build you your own CRM for your own business and not having to pay Salesforce a subscription?
That is $1 trillion question a lot of people are trying to solve.
And so in that way, it seems kind of fitting, right? That or it's the way markets work and the way these things tend to play themselves out. But then you can sit there and see an environment. Now, obviously, they'll be benefiting a lot from the AI side of things and the LLM, but you can also see a scenario where that brainchild of theirs, right, that huge breakthrough, that advance ends up being what eats their lunch.
Yeah, and I think that is a like very key part of this is I think AI is going to. I think some of these companies will look back on and be like, "Man, AI really did insert name here that no one currently expects AI to do in." Right? I think on the software side, people expect it, but what I would say there though is like between here and you just telling you making your own software, between here and there is software companies using AI to make software incredible. So like, will we maybe get there? Sure. But between here and there, they're just going to use it to make it amazing. It kind of reminds me of like 3D printing when that came out. People were like, oh, well, I won't need XYZ anymore. I'll 3D print it myself. Well, no one's doing that, but a lot of people are using things where they 3D printed everything. Like, I worked at a rocket lab. The amount of parts on a rocket that takes things to space that are 3D printed, like metal and stuff, it's a lot. Like it makes so much sense to 3D print that stuff that's kind of what we do. So some of these things have they find a way to get in the back where you don't notice them, get their tentacles and everything. Like I've always said with blockchain, like it'll just be in everything. You just won't notice it the same way, like, Excel spreadsheets run the world,
Yeah. I'm just wondering, I keep going back to this dynamic of what does it mean? What does it look like where the biggest economy and the most powerful country in the history of the world has a market where, 3 to 4 of the stock's market caps are equal to their entire economy. And the reason I keep bringing that up is because I don't know.
It means the world's global. I think that's a big part.
It absolutely means they're global, but it also opens up Pandora's box as far as how do you regulate something like that? Because I want to say, what is it? 63% if you look at Meg 7, 63% of their earnings come from overseas anyway.
I can't remember. I'll look it up. It may not be that
something
high,
like that. It's a lot. Yeah. So when you look at institutions that large, like for instance, question, right? The way we currently have it, corporations can donate to Citizens United via the Citizens United decision. Corporations, U.S.-based corporations can put money into elections. Do we really consider them U.S.-based corporations anymore?
Well, we do because we're telling Europe they can't tax them.
Right, but what I'm saying is when you look at how much of their earnings are coming from overseas, I think it opens up a lot of really tough questions, which is,
if we go after them hard, they just leave.
Yeah. And then also, I think you also need to consider characterizing them or categorizing them differently, because when you look at their incentive base, right, it is increasingly getting to the point where, like I said, let's pretend my number is correct. And I think it is. Now, I might be talking about the S&P 500 in general, but that has to be mostly, when we look at overseas profits, I guarantee Omega 7's, getting the vast majority of that, right?
Yeah, tech is who can do it.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
You might need to revisit. Well, I mean, I think you should revisit it anyway. But like a Citizens United decision, meaning, a U.S.-based corporation, sure, but what happens when more of that company's earnings come from overseas? Right, because there's always been, companies could do crappy things and treat workers bad and break rules and defile a river, and what I mean. We've got all these decisions, right? But at the same time, the vast majority of corporations were invested in the success of America, meaning as one goes, we all go, right? To some degree, to a large degree. Well, now you're looking at these corporations where, I'm not saying that they're like screw the U.S. or anything like that,
but they're more like states themselves than they are.
Yeah, it's almost like they're city states within the state. You know what I mean? And if you don't think that's the case, go back and kind of with this conversation in mind. Go back and take a look at COVID again. Go back and take a look at the influence that those tech companies and social media companies and the way that they were working, in many cases illegally. Now, they were being pressed by the government, so I'm not putting this on them. But you can already see how that interplay is. I think it's going to bring up a lot of really, really interesting, potentially scary antitrust issues, and it even seems too small to call it antitrust.
Yeah, I agree. To me, like you're saying, it's so different. Like, why not have if your company's worth more than $1 trillion, you go in the special bucket, and here's the special rules. Now, it may take you 3 years to write those rules to make it all make sense, to figure it out. But one of the problems is a lot of these companies are here because Europe sees everything you're saying, and they have rules. Like, they are so aware of this stuff. Europe's problem is they're really good at regulating, but they're too good at regulating.
Yeah, they're too good at it.
So if you write a bunch of rules, like if I'm any of these companies, I'm looking at it like, yeah, no thanks. Like we'll make money off you guys, but we're not going to like park there and headquarter there. And going back, so a weighted average of Mag 7 earnings comes out to about 44.5% from overseas. But I'll go through these because it's interesting. Apple's about 57%. Microsoft right about 50. Amazon's only 18, which obviously makes sense.
Makes sense. Yeah.
Meta's 62. That's a lot. Alphabet 51. Nvidia 53. Tesla 51. That's more than I thought. And Broadcom, which is actually technically in the Mag 7 now, if you look at it by market cap, Broadcom 71% overseas revenue.
Jeez.
Yeah. So
and like I said, I'm not. Just for people listening right now, like I'm not pointing to a certain outcome at all. I'm sitting there trying to look at a world that is in a market that's in a place that no one's ever really seen before. No, we've never traveled this way before.
Standard Oil at 3% was a dragon that had to be slain.
Yeah,
it was a threat to society.
Yeah, and now 3% doesn't even make you the biggest. I mean, I got to believe we've got. Well, I think Microsoft's bigger than. Yeah, Microsoft is bigger
as a percent of U.S. GDP, which isn't a fair comp. More
fair enough. Yeah. Okay. So So then look at them. So they're 50%, right? So 50% of the earnings come from overseas. So knock them down by 50%. Yeah, a bunch of them are still
2x what Standard Oil was.
Yeah. Point is you've got a bunch of Standard Oils running around at the same time,
right? Which
is just wild. Just wild. And then, like I said, what does that mean? I don't really know. I don't know. I mean, I know that at some point that becomes a problem. How far away is that? I don't know. It feels like you're already a point to where legislation and law needs to come in and say, like I said, Citizens United, those corporations should not be able to contribute to political campaigns.
Yeah, that may be right. I know this is more of a left view, but like that might be right up there with like Iraq and Afghanistan as far as failures of the U.S. in the last 25 years. It's such a massive failure.
It is. And I am Mr. Free Markets, but when you're looking at companies that size with that much money and that much reach, right? And over half of their profits come from overseas. If you allow them to participate in elections, that opens a lot of really strange doors.
And not just participate in elections, but do a bunch of other political stuff. Like we talked about and this goes both ways. It's not an either or thing. I think they've gotten more political as time's gone on. So you've seen it pretty, clearly lately, but, paying important politicians or their wives millions of dollars to do a documentary on them, or, what's it called? The inauguration, where they all donated millions and millions of dollars to the inauguration, because technically you could do that. It has nothing to do with politics. It's just like a little party that, we're going to have, like, but all that stuff, we all know what that money's for. Right. And you look at some other countries, they will have an election, and the whole process is like a couple weeks, and the candidates are spending like $3 million instead of like $1 billion, like, you see that and you're like, man, that must be nice. Like, it's a lot easier to focus on the issues whenever people aren't throwing $1 billion at ads and social media manipulation and stuff.
Yeah. It's why it's very, very wild times. And here's the thing. It's made me very, very less sure about my outlook on the broader market in general. And here's why. It would make all the sense to me in the world on so many different levels if these international markets continue to play catch up with the United States. I got to see it to believe it, though. And here's this is, you and I have talked about this a lot, and I've said it on the show before. But the reason for that is every person in the world that manages assets is deathly afraid of being too light in one type of stock, and that is U.S. tech. And the minute that starts running, I'm just telling, as a guy that manages money, you do too. You and I both know a lot of guys are going to be like, all right, man, we don't want to cut that, but we got to put more in the queues.
Yeah. It's like I said earlier today, it's career risk embodied, it's like it's its own thing. To me, this was easy early in the year. Like, it was easy to say, hey, like we did, pound on the table, like buy overseas, because we were going to cut the trade deficit, the budget deficit, and the rest of the world was like, cool, we'll do fiscal. And it's like, well, this is a really easy game.
Yep.
Get your darts out, throw them at the dartboard, whatever country it hits, just put your money there and you're going to win. But now, now that we're not cutting those deficits, different story.
Well, and look, it's not fiscal in the way that we would, quantify it normally. Meaning, you wouldn't call what they're doing fiscal; it's deficit spending. But when let's not lose sight of that, right? We came in talking about cutting the deficit. We're increasing it this year alone by 25%, right? Like, that's fiscal. That's fiscal. And it's much more.
Deficit above 5 is just wildly supportive. It just
and I just don't. It's kind of like you and
not doing that.
Yeah, and so now all of a sudden you're looking at it and going, okay, wait a second, we are going to juice an additional $500 billion in government spending this year. Oh, okay. Well, now we're going to $2.5 trillion deficits, and here we go. The picture, the outlook has changed, right? Now, again, it's not fiscal in the sense that
it's not
consumers
and stuff, but
but it's a hell of a lot more stimulative than quantitative easing.
Yeah. Oh, yeah. The fiscal and monetary thing is just not even close. That's why I like to me, all this argument about rate cuts, whatever, who cares? Watch the big beautiful bill, because how much that adds to the deficit matters way more than the next 100 basis points from the Fed.
The other thing I'm thinking about, Chase, is that, again, our timing has been off, but I would not be surprised if a year and a half we're looking back on this moment right now and going, okay, here's when that big blow off top, here's when things started to get really nuts. Right? Because look at where you're at on valuations, all the different stuff that we're talking about, the fact the deficit's going up. And now even Powell's talking about, you're going to be cutting into this.
I will kind of push back only because I think, and I know this is a weird view, but I think if they do cut rates a bunch, it will actually hurt growth. It will hurt inflation. It will push us into a bit of a malaise more than it will be juice. Now, obviously, some nonsensical tech stuff can maybe pick itself up there, but I still see the headwinds. And I think if you get going hard enough, the long end will have to creep its way back higher on yields. State and local governments are hurting, and it looks like as currently structured, this bill will put that much more pressure on state governments. Which trickles down to local governments. And that stuff matters. So I do think there are some headwinds. But hey, you do enough deficit spending, and there's no headwind, but other than inflation, of course. But
yeah.
As long as you get $70 and you can press fiscal and you can get away with a bunch.
Yeah. Other than that, to me, this unless something else happens, this Iran thing. At least it appears to me to be completely over. I think
I won't say completely over. I'll say completely over for now. But so I'm glad you brought this up. This is super important, and we're seeing this in the difference between the way the president and the vice president are talking about it. If you really boil this whole thing down, what was the point of all this? Iran can't have a nuke. How do you get a nuke? It's enriched to 90%, and you put it in a weapon. Obviously, it's more complicated than that, but they have 60% enriched uranium. We don't know where 400 kilograms of that is. That's what really matters. Does messing up your centrifuges that we know about matter? Of course it does. Does this set them back, slow them down, all that kind of stuff? Yes. But they still have enough material to make, a dozen nuclear weapons that we don't know where it is. We don't know if they can push it from 60 to 90. Maybe they have everything they need to put it in something so it's over for now. And I clearly the president wants it to be over, but JD Vance is being really clear lately, like, hey, we don't know where that stuff is. That's a problem. We need to talk to the Iranians about it. We need to negotiate it. The ultimate fear is 60 to 90 under our noses. They're saying IAEA inspectors no longer welcome. What's the point? So I think it's over from a market perspective for sure. But like,
good distinction. Good
Just
distinction.
wake up one day and Iran could be like, cool, we have it now. Now, no one probably believes them because they talk immense trash and they rarely back it up. But just like they obliterated our base that not one missile landed on. But
at this point, I would guess that might even be bullish for markets. Right? They'd be like, hey, the threat,
the chance of a war goes down because no one's going to mess with them anymore.
Well, and the threat of thermonuclear war almost assuredly guarantees additional rate cuts.
Yeah, there's no reason to hedge at the end of the world because if it happens, well, who cares, right?
Yeah.
We're not here to collect our hedges anyway.
Yeah. It's also weird too. It's kind of a weird dynamic because I mean, some of these, I can, the two biggest to me that just stick out like sore thumbs are Apple and Tesla, obviously, where the valuations don't make any sense. As for the rest of them, I think the valuations are pretty defensible. I mean, they're not cheap.
Well, not Microsoft, but Microsoft's a little too expensive. But
13 times earnings for the largest company on the S&P 500. I mean, that just reeks of bubble.
Speaking of, just so everyone knows, if you took all of search revenue away from Google, that's what their price of sales would be, which means the market has essentially,
discounted,
fully discounted the complete obliteration overnight of all search revenue.
And man, look, that's this. So if people want to know why I get frustrated with this market, that's it. Okay, we price nothing in except we're pricing Google search as zero. I mean, come on. It's so dumb it hurts, right? It's just so dumb it hurts. And like you and I said, Google's already proven that that's not going to happen. Meaning if search
are growing,
and if search goes away, one of the biggest benefactors is going to be Gemini.
Yeah, I mean,
their AI.
They're already cannibalizing themselves. Now, do I think do I think search is going to get hurt and lose some revenue? I do. But
I think
their non-search revenue has grown at 17% on a 5-year CAGR. So like that stuff's fine.
Yeah,
that's more gross, I think, than or at least roughly as much as Microsoft has. So like,
I'm just glad. Now I know you're a big bull on Google too, so I know that you're not. This isn't, but sarcastically, I'm just glad you've pivoted to my take of saying that I thought that. Well, I didn't do the numbers. I didn't go through them as concisely as you laid them out on our investment meeting this morning. But I'm just looking at the different valuations of the companies and as a comp and going, man, at this point, and again, this is not an investment recommendation to anybody else, but it kind of feels like a classic scenario for me. Is like, hey, if you liked it at 180, you got to love it at 160. And it just feels like you're buying a company that's got a lot of bad news priced into it. And the market is not at all paying attention to any of these things being home runs. It's not at all.
Fully price in the left tail, ignore all the right tails. Even if, I admit most of the right tails, like the probability they work out, especially a combination of them, of course, it's not that high. But if, let's say there's 5 irons in the fire, that are right tail, that are, if it goes right, it's a big deal. I don't know if they're all 20% chance, like, if one of those goes right, if phones catch on fire, if their AI stuff becomes a winner, if their new glasses become a big winner, like that, obviously Waymo, if they get the cost down on the vehicles and they truly controlled 70% of that market 10 years from now or something, like, I don't know. They have a lot of ways to win.
I think that they've got a lot of ways to win. And here's another one that I'm not thinking anybody's thinking of. I think that they're going to get levels of participation and levels of cooperation from other automobile manufacturers that nobody's counting on right now. And the reason why is because those one of the autonomous driving is one of the biggest threats to every automobile manufacturer out there right now. Right? Meaning it's not like EVs. Some people get in there, some people, if you're an automobile manufacturer and you plan on being competitive over the next decade, you better have a full self-driving situation, right? And I mean, I don't think you can make any sense of the difference in the way that Google and Tesla are valued. I don't think it make any sense. The one argument I think you could make is that Tesla has a strategic advantage because not only will they, now they don't yet. That's the other ironic thing. They don't even have the software yet, right? I mean, they've got driverless taxis that have to have somebody sitting in the front seat and another driver at a support center somewhere else. So you've got 3 driver cars right now in a geofence. That's the other thing. Oh, everybody's, they're hitting the ground. They've launched full self-drive. No, they haven't. This is like a beta test, right? Geofenced. I mean, this is basically, when you're a kid, you go to the ride where you get to drive the car, but the car's on the track, and you're honking the horn and you're doing, all that kind of stuff. And, but you're not really driving that. I mean, that's kind of what it's like. Having said that, I would think the fact that Tesla owns both the hardware and the software, that's an advantage. But then you flip over to a company like Waymo, and I could say conversely, the fact that they don't have the hardware and that everybody is going to want their hardware. I mean, not everybody, but I mean, Waymo's at the top of the heap right now. So, I mean, if you want a competitive full self-driving solution, I've got to believe several different car manufacturers are going to go with their solution. And, to say that's what's really interesting is I haven't heard anybody talk about this. I would love to see a breakdown of people that really understand the automobile industry, talking about that different dynamic. Is it better to be the manufacturer and the owner of the hardware and the software, or is it better? Because if you think about the modern software company, they've all kind of succeeded doing it the way that Google's currently trying to do it, right? Which is develop the software and then sell it to all the hardware makers, right? But I don't know, the automobile industry is obviously a lot different than the computer industry. So will that same dynamic play out the same way on the automobile side? I don't know.
Yeah, it remains to be seen totally. That's for sure. But what we do know is like the one advantage Tesla has, or they will once they do roll this out fully, is just the cost of the car. Like is way less right now than, at least reportedly, than what Google's dealing with. But to your point though, and Google's costs are coming down, and they they're going from Jaguar I-Paces that are expensive to begin with to, well, they're trying to go to the Chinese cars, although who knows what tariffs. But eventually you probably get to, let's say you use one of those BYDs and just put all your gear on it, and the car costs $12,000 or whatever. And as you scale with all the gear, the price will collapse for that stuff.
Well, and dude, the other one too is those Hyundais. I mean, Hyundai's got some really competitively priced offerings as well.
And I think Google is using a little bit of those, and they may have to pivot harder to those for Waymos.
Yeah. Why do I feel, I could have sworn I've heard something about Waymo working with the Ionics, that Ionic.
I think that might be right. Yeah.
But don't take that in the bank.
The Geely, like minivan looking thing, like the flagship, but I just figure that gets tough with whatever 25% tariffs or.
That's another.
We've already talked about this. To me, it makes sense to let those Chinese companies come build their factories here, but.
Yeah, I would definitely agree with you. One other interesting thing, and this will be it for me on the day. I am not at all saying that I think the downside is over here. I will say this again, watching this market for a really long time, I thought gold was a really interesting thing to watch today. Coming into the day, if you would have told me about the market action, so a week ago, if you'd have come back and told me, okay, here's how things are going to play out on Tuesday, this is what you're going to be looking about. Where do you think gold's going to be? I would have thought gold would have gotten hit way harder. And it did early in the session. And then watching it climb back, that was interesting to me. I really thought it was one of those days where gold and the miners would continue losing ground throughout the day. Watching a bid come into them and it, look, they didn't have a good day. Okay, I'm not saying that. But, I mean, they clawed back over half of their losses toward the beginning of the session.
It's not like oil that, just vaporized 20% in 2 days. So,
yeah, I didn't. I also wouldn't have guessed that. If you'd asked me what I think this would do to oil, I thought you'd see an 8 to 10% pullback. I didn't think you'd
Clearly
see
that was all geopolitical premium.
I guess, which that's another question that you got to ask about the underlying economy, right? If now oil is a different one because there's so many different cross currents feeding into it. But, if demand has oil sitting at 62, 63, it's kind of hard to make an argument that growth is really kicking.
Well, I think the problem for oil is more supply, because OPEC just coming in hot with 400 plus thousand barrels every month. Demand isn't good, but even if demand was good, that would be a problem, I think.
Yeah, it's wild times out there, man. Anything else you saw that was interesting?
Nope. No, we're pressing 50, so I think we're good.
All right, guys. Well, hey, a little bit longer show today. As always, visit us on social media. We're on InstaFace, as Chase likes to call it, Twitter. Why do I always want to say LinkedIn? It's like the one that we're not on that I hate. We're on everything but LinkedIn, Instagram. And then you find us on YouTube. Just search Know Your Risk Podcast. Got some other good interviews coming up, so that'll be fun. But
interesting. By the way,
what's that?
Now that we like Snapchat, we got to get on Snapchat.
Oh yeah,
disappearing podcasts or whatever. I don't know how this stuff works.
I was shocked to see that. I sat there and I went, Snapchat's trading at like 3.8 times revenue. I was surprised to see that. I thought it would have because I'll tell you, the kids love it, man. The kids love it. They love some Snapchat. No, it's not. Nothing else does.
Speaking of, it's my daughter's birthday, and if I could buy stock in American Girl right now, I think I'd do that.
Oh yeah, I remember the American Girl days. They're not cheap. Anyway, all right, you guys have a wonderful evening. We will be back again tomorrow. Until then, you're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.